Hi traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Now, have you ever wanted to trade Forex quickly and efficiently without holding positions for hours or days? Now, scalping might be the perfect strategy for you. In this video, I'm going to break down a simple Forex scalping strategy for beginners, all right? One that is easy to follow, works on small time frames, and helps you catch fast market moves. All right, you're going to learn the best indicators, entry and exit points, and risk management techniques to trade like a pro scalper. All right, so make sure you watch until the end because I'll also go over common scalping mistakes that many beginners make and how to avoid them. Now, let's just quickly dive right in. Before we jump into the strategy, let's first understand what Forex scalping is, okay? Now, scalping is a short-term trading strategy where traders enter and exit trades within minutes, aiming to catch small price movements. Now, unlike swing trading or day trading, scalpers don't hold positions for long. They take multiple trades in a session, capturing small market moves and stacking up quick wins. Okay, now some of the key features of scalping include using of short time frames, for example, 1 minute time frame or 5 minute time frame, and then quick entries and exits. Okay, trades last anywhere from a few seconds to a few minutes, and then scalping relies on high liquidity. It is best suited for major currency pairs like the Euro USD, the GBP USD, USD JPY, and so on. As you can see, this is the GBP USD chart. Also, scalping requires tight risk management. Since trades are quick, stop losses and take profits need to be well paced. All right, scalping is great for traders who enjoy fast decision making and active trading, but it also requires discipline and a solid strategy. Now, let's just quickly go over the best approach for scalping in Forex. When it comes to scalping, using the right indicators and tools can make a big difference. Now, here are some of the most effective indicators to use. The first we're going to be looking at is the moving averages. All right, we're going to be using the 200 EMA and the 50 EMA. This is one of the common combo, right? The common combinations. Now, the 50 and 200 EMA help identify trend direction. When price is above these lines, the trend is bullish. When price is below, the trend is bearish. As easy as that. Secondly, we're going to be looking at the stochastic oscillator. All right. This momentum indicator helps determine if the market is overbought or oversold, signaling potential entry points. And then next, we're going to be looking at the Bollinger Bands. All right. Now, the Bollinger Bands help identify volatility and price reversals. Price touching the upper or lower band can indicate a potential trade setup. And finally, we're going to be talking about support and resistance zones. Resistance are above, supports are below. So these are key price levels where the market tends to react. And scalping works best when price respects these zones. Okay, so using a combination of these indicators helps filter out bad trades and confirm high probability setups. Now, let's just quickly go over the step-by-step scalping strategy. All right. The first step is to choose the right time frame. It is necessary, very important. You can set your chart to the 1 minute or the 5 minute time frames for fast trades. Okay. Then the second step is to identify the trend. All right. You can use the 50 EMA and the 200 EMA. If the price is above both, you look for buy trades. If the price is below both, you look for sell trades. Then the next, so after you have identified the trend, the next thing for you to do is to wait for a pullback to key levels. Okay, so you look for price to retrace to the 50 EMA or the 200 EMA. For example, we can see what happens here. This is a buy trend, right? Now the price crossed above the 50 and 200 EMAs. and now it is retracing back to the 200 EMA. So if we have a bullish confirmation around here, if we actually have maybe a bullish candlestick pattern develop around here, it could be a good entry point. Then after that, it's important, well, after you have waited for a pullback, around the moving average, or strong support or resistance zones, and then perhaps you have the price touch the Bollinger Band, maybe the lower Bollinger Band in a buy trend, and you see a rejection, a bullish pattern forming. It could be a good time to enter a buy. You can also use the stochastic oscillator for confirmation. If the market is oversold, and that is exactly what is happening, you can see that if the market is oversold below 20, you should be looking for buy setups. But if the market is overbought, which is above 80, you should be looking for sell setups. Okay, and then finally you enter your trade. Once confirmation appears, you enter your trade. Okay, you can buy when the price rejects the support and stochastic is oversold, or you can sell when the price rejects resistance and stochastic is overbought. All right, then the next step is to set your stop loss and take profits. Okay, you can just place a stop loss below the support zone for your buys or above the resistance zone for your sells. Okay, and take your profits at the next resistance for a buy trade or at the next support for a sell trade. Now, this simple strategy helps avoid emotional trading and keeps you focused on high probability setups. Now, even with a solid strategy, many beginners still make mistakes when scalping, and here's what to avoid. Okay, I need to let you know some main issues that you should be avoiding. One is overtrading. Scalping is fast-paced, but taking too many trades leads to bad decisions. So just stick to high-quality setups. Okay. Secondly, do not ignore the spread. That is the reason why we focus on low spread pairs like Euro USD, GBP USD, and the rest. Okay, major pairs. All right. A high spread. Remember that the spread is the difference between the ask price and the bid price. Okay, a high spread can eat up potential gains, and because you are scalping, literally, your price movements are just short price movements. So if you imagine, if you enter a trade here and you exit here, and you have a wide spread, that wide spread is going to eat into your profits. So just look for pairs that have small spreads. Okay, and then it's important to trade in high liquidity markets. Avoid scalping during slow market hours. Okay, the best times are London and New York sessions when volatility is high. Okay, then finally, do not use large lot sizes. Okay, that's a big mistake. Since scalping involves tight stops, risking too much per trade can lead to unnecessary losses. Okay, so always use proper risk management. By avoiding these mistakes, you scalp the market with more precision and confidence. Now, let's just quickly summarize the key points. The first is scalping is a short-term trading strategy that works best on 1 minute and 5 minute charts. All right. Secondly, the best indicators for scalping include your moving averages, stochastic oscillators, Bollinger Bands, support and resistance levels. Okay. Next, follow the trend and wait for the price to pull back to key levels before entering your trade. Okay. Next, always confirm entries. It's important to get confirmations with price action and momentum indicators before you enter your trade. And avoid common mistakes like overtrading, ignoring spreads, or using large lot sizes. Okay, mastering this simple scalping strategy can improve your ability to trade quickly and efficiently, making it easier to find opportunities in any market condition. Now, if you enjoyed this video and found it helpful, make sure to smash that like button and subscribe for more powerful trading strategies. Also, drop a comment below. Do you prefer scalping or day trading? Let me know in the comment section. Thank you for watching meanwhile, and I hope to see you in the next video.